Ind AS 12. Income taxes. Income taxes includes current tax and deferred tax. Therefore, current tax plus deferred tax equals to income tax. What is current tax? Current tax is the amount of income tax payable that is recoverable in respect of the taxable profits or tax loss for a period. So, income tax payable will be the current tax. Income tax liability for the particular period will be the current tax. Recognition. Tax, if unpaid, it will be treated as liability. If paid in excess, it will be treated as asset. Measurement. Current tax liabilities and assets should be measured using the tax rates that have been enacted or substantively enacted by the end of the reporting period. That is, using tax rate applicable for the current period. So, for calculating the current tax liability or current tax asset, first take either tax rates enacted or going to be enacted for the previous year. Next, accounting treatment of current tax expense in the statement of P&L. If item of income or expense is recognized in P&L, then current tax expense on such item will be recognized in P&L. But if items related to OCI, current tax on such items will be recognized in OCI. That means the meaning of this sentence is, if income or expense pertains to P&L items, current tax expense should also be recognized in P&L only. If income or expense pertains to OCI, current tax items should also be recognized in OCI. Offsetting current tax asset and current tax liability. Offsetting of current tax asset and current tax liability is allowed only if, first condition, entity has legally enforceable right to set off and intends to settle on net basis. That means offsetting of current tax asset and current tax liability is allowed only there is legal enforceability and intention. The entity has a legally enforceable right to set off when they relates to income taxes levied by same tax authorities. That means if taxes are levied by same tax authorities, then set off is allowed. Next, deferred tax. The following steps should be followed in recognition, measurement, and presentation of deferred tax assets and deferred tax liabilities. First one, compute carrying amount of assets and liabilities, compute tax base of assets and liabilities, compute temporary difference, classify the temporary difference, assess deductible temporary difference, tax losses, unused tax credits, determine tax rates for deferred tax, calculate and recognize deferred tax, accounting for deferred tax, offsetting deferred tax asset and deferred tax liability. First one, step, compute carrying amount of assets and liabilities. What is carrying amount? It is the balance as per accounting records. Step number 2, compute tax base. Tax base is the amount attributed to asset or liability for tax purposes. Tax base in case of asset, tax base in case of liability. Tax base in case of asset. It is the amount that will be deductible for tax purpose in future periods. Tax base in case of liabilities. All liabilities except revenue received in advance. That is carrying amount minus amount that will be deductible for tax purpose in future periods. Revenue received in advance. Carrying amount less amount that will not be taxable in future periods. If any asset is not taxable or if any liability is not tax deductible, that is, if difference is other than temporary, then tax base equals to carrying amount. Step number 3, compute temporary difference. Temporary difference equals to carrying amount of the asset or liability minus tax base. Step number 4, classification of temporary difference. Temporary difference are to be classified into two categories, taxable temporary difference and deductible temporary difference. How to calculate taxable temporary difference and deductible temporary difference? Here carrying amount is constant. In case of asset, if carrying amount is greater than tax base, it is a taxable temporary difference. If carrying amount is less than tax base, it will be deductible temporary difference. In case of liability, it is reverse. If carrying amount is greater than tax base, it is deductible temporary difference. If carrying amount is less than tax base, it is taxable temporary difference. All taxable temporary difference give rise to DTL. All deductible temporary difference give rise to DTA. If carrying amount equals to tax base, then there will be no temporary difference. There will be no DTA and DTL. Step 5, assess, also reassess Deductible temporary difference, tax losses, unused credits. Deductible temporary difference reduces the future taxable profits. Therefore, an entity should recognize DTA on deductible temporary difference only when it is probable that taxable profits will be available against which DTA can be utilized. For utilization of DTA, the standard provides three-step criteria to be applied in serial order. What are the steps? First one, existence of taxable temporary difference. The entity should see whether there are sufficient taxable temporary differences whose reversal pattern matches with the reversal pattern of the deductible temporary differences. Second, probability of future losses, future profits. Probability of future profits. If it is probable that there will be sufficient taxable profits, then to the extent of available profits, DTA should be recognized. Third one, availability of tax planning opportunities. If even after applying criteria number 2, still there are unrecognized taxable temporary differences, the entity shall see whether any tax planning opportunities are available. Tax planning opportunities are actions that the entity would take in order to create or increase taxable income in a particular period before the expiry of the tax losses. So these are the three criteria for utilization of DTA. Next, unused tax losses and unused tax credits. DTA shall be recognized for carry forward of unused tax losses and unused tax credits to the extent it is probable that future taxable profit will be available against which it can be utilized. Reassessment of unrecognized DTA. At the end of each year, entity should reassess unrecognized DTA. It may need to recognize a previously unrecognized DTA to the extent it has now become probable that future taxable profits will be available for DTA to be utilized. Step number 6. Determine tax rates for deferred tax. Deferred tax shall be measured at future tax rates expected to apply to the period when the DTA will be realized or DTL will be settled, and such rates should have been enacted or substantially enacted by the end of the reporting period. Also, DTA or DTL should be created using the tax rate which is consistent with the expected manner of recovery or settlement. Example, assets carrying amount is 100 and tax base is 60. Tax rate if sold will be 20%. If used, it is 30%. Case number 1. If entity expects to sell the asset, DTL will be 100 minus 60, that is 40 into 20%, that is 8. Case number 2. If it expects to retain the asset and recover its carrying amount through use, DTL will be 100 minus 60, that is 40 into 30%, 12 rupees 12. The DTA or DTL that arises from the revaluation of an non-depreciable asset. The tax rate applicable to recovery of carrying amount through sale should be used. Distribution of dividends. In some jurisdictions, income taxes are payable at a higher or lower rate if part or all of the net profits or retained earnings is paid out as a dividend. In some other jurisdictions, income taxes may be refundable or payable if part or all of the net profit or retained earnings is paid out of as a dividend. In these circumstances, current and DTA or DTL are measured at the tax rate applicable to undistributed profits. Step number 7. Calculate and recognize deferred tax. Deferred tax is of two types: deferred tax asset, deferred tax liability. How to calculate deferred tax asset? Deductible temporary difference into tax rate. How to calculate deferred tax liability? Taxable temporary difference into tax rate. DTA or DTL should not be discounted. DTA shall be reviewed at the end of each reporting period to check whether any recognized DTA has to be derecognized due to probability of insufficient profits, or any unrecognized DTA has to be recognized due to probable sufficient taxable profits. Step number 8. Accounting for deferred tax. The accounting of deferred tax effects of a transaction is consistent with the accounting for the transaction. Accounting for deferred tax. If item pertains to P&L, for example depreciation, deferred tax should be recognized in P&L. If item pertains to OCI, Example, revaluation profit. Deferred tax should be recognized in OCA. If item is recognized directly in equity, example, correction of error. As per Ind AS 8, deferred tax should be recognized in equity. Deferred tax arising on business combination. Deferred tax will be adjusted against goodwill. Carrying amount of DTA or DTL may change even though there is no change in the amount of the related temporary differences. This can result from a change in tax rates or tax laws, a reassessment of the recoverability of DTA, or a change in the expected manner of recovery of an asset. In such cases, the resulting deferred tax is recognized in P&L except to the extent that it relates to items previously recognized outside P&L. Next, step number 9, offsetting deferred tax asset and deferred tax liability. Offsetting of deferred tax asset and deferred tax liability is allowed only if entity has legally enforceable right to set off current tax assets, deferred tax assets against deferred tax liabilities, and deferred tax asset and deferred tax liability relates to income tax levied by the same tax authority. Both the conditions need to be satisfied in order to offset deferred tax asset and deferred tax liability. Business combination, practical application and exceptions. The identifiable assets and liabilities acquired in a business combination are recognized at their fair value as on the date of acquisition. Temporary differences arises when the tax base of an asset and liabilities acquired are not affected by business combination and are affected differently. For example, when the carrying amount is increased to fair value, but the tax base remains at cost to the previous owner, a temporary difference arises. The effect of such temporary difference is summarized below. Temporary differences arising on assets and liabilities acquired other than goodwill, resulting DTA DTL will affect goodwill. In case of goodwill, if goodwill is not tax deductible, difference between carrying amount and tax base is other than temporary. Therefore, do not recognize deferred tax on goodwill. If goodwill is tax deductible, if difference is temporary, then recognize deferred tax on goodwill. Due to business combination, it might be possible that acquirer's unrecognized DTA may also prove to become recognized. In such case, unrecognized DTA of acquirer being recognized will not impact goodwill. Asset acquisition. If initial recognition of an asset or liability is a transaction which is not a business combination, and at the end of the transaction, neither affects accounting profit nor taxable profit, then no DTA or DTL is to be recognized. In case of share-based repayments, temporary difference may arise in a transaction of share-based repayments. For example, an entity may recognize a share-based payment expense as per Ind AS 1 or 2 in each year, but not receive a tax deduction until the share options are exercised. The difference between tax base of employee services received to date to date being the amount permitted as a deduction in future periods under taxation laws, and the carrying amount of nil is a deductible temporary difference that results in a deferred tax asset. In such case, deferred tax will be recognized in P&L as the expense pertains to P&L. So deferred tax will also be recognized in P&L only. Next, temporary difference associated with investment in subsidiaries, branches, associate, and joint venture. Temporary differences arise when the carrying amount of the investment, which is share of the net assets, including the carrying amount of goodwill, becomes different from the tax base, which is often cost of the investment. Generally, the taxable temporary difference will get reversed on distribution of dividend. An entity shall recognize a deferred tax for all temporary differences, except when following conditions are satisfied. First one, temporary differences associated with investment in subsidiaries or joint ventures are recognized deferred tax except when parent controls the dividend policy of its subsidiary and parent has determined that those profits will not be distributed in the foreseeable future. The same considerations apply to investment in branches. In case of investment in associate, parent company does not control dividend policy, hence recognize deferred tax except when agreement is entered between parties which states that no dividend will be distributed in the foreseeable future. In case of investment in joint venture, recognize deferred tax except when the venturer can control the sharing of profits and it is probable entered into agreement that the profits will not be distributed in the foreseeable future. Next, what is the difference between Ind AS 12 and AS 22? First one is regarding approach for creating deferred tax. Ind AS 12 is based on balance sheet approach. It requires a recognition of tax consequence of difference between carrying amount of assets and liabilities and the tax base. AS 22 is based on income statement approach. It requires a recognition of tax consequence of difference between taxable income and accounting income. Difference are classified into permanent and timing difference. Second one is regarding limited exceptions for recognition of DTA. DTA is recognized if it is probable that taxable profit will be available. DTA is also created if there are carry forward of unused tax losses and tax credits, that is MAT credits. Existence of unused tax losses is strong evidence that future taxable profit may not be available. Therefore, in that case, recognizes a DTA only to the extent there is a sufficient taxable temporary difference or there is convincing other evidence sufficient taxable profit will be available. In case of AS 22, DTA are recognized and carry forward only to the extent that there is a reasonable certainty that sufficient future taxable income will be available, where DTA is recognized against unabsorbed depreciation or carry forward of losses under tax laws, recognized only to the extent that there is virtual certainty supported by convincing evidence that sufficient future taxable income will be available. AS 22 explains what may be considered as virtual certainty supported by convincing evidence. Third one, a recognition of current tax and deferred tax. Current tax and deferred tax are recognized as income or an expense and included in P&L, except if transaction is recognized either in OCI or directly in equity. In those cases, tax is also recognized in OCI or in equity as appropriate as per Ind AS 12. As per AS 22, it does not deal with a recognition of current tax and deferred tax concept. Next, investment in subsidiaries, associates, and joint venture. As per Ind AS 12, DTL is recognized for all taxable temporary differences associated with investment in subsidiary, associate, and joint venture if certain conditions are satisfied. However, AS 22 does not deal with investment in subsidiaries, associate, and joint venture concept. Next, elimination of profit and losses resulting from intra-group transactions. As per Ind AS 12, deferred tax should be recognized on temporary difference that arise from the elimination of unrecognized profits resulting from intra-group transactions. As per AS 22, deferred tax is consolidated financials. Deferred tax in consolidated financials are a simple aggregation of the deferred tax recognized by the group entities. Next, DTA or DTL arising out of revaluation of assets. Ind AS 12 requires that DTA or DTL arising from revaluation of non-depreciable asset shall be measured at tax rate applicable on sale of the asset rather than through use. AS 22 does not deal with this aspect. Next, changes in entities tax status are that of its shareholders. Ind AS 12 provides guidance as to how an entity should account for the tax consequence of a change in its tax status or that of its shareholders. AS 22 does not deal with this aspect. Next, guidance for recognition of deferred tax in tax holiday period. Ind AS 12 does not deal with this guidance for recognition of deferred tax in a tax holiday period. AS 22 specifically provides guidance regarding recognition of deferred tax in situations of tax holiday under Section 80IA and 80IB and Section 10A, 10B of Income Tax Act 1961. Similarly, AS 22 provides guidance regarding recognition of deferred tax asset in case of losses under the head capital gains. Next, in case of company paying tax under Section 115 JB, Ind AS 12 does not deal with this aspect. AS 22 specifically provides guidance regarding tax rates to be applied in measuring DTA or DTL in a situation where a company pays tax under Section 115 JB. Guidance on uncertainty over income tax treatment. Ind AS 12 gives specific guidance, special guidance on it. However, AS 22 does not give any guidance regarding uncertainty over income tax treatment.